So, Procter Gamble just dropped their earnings, and at first glance, it looked like a total home run, a clear win, right? But then, the stock's reaction? It told a completely different story. It was a classic beat and fade. So, the big question is, what did investors see that made them turn a big pre-market pop into an all-day slide? Well, let's dig into the numbers and figure it out together.
Okay, so here's how we're going to break it all down. First, we'll look at those headline numbers that got everyone excited. Then, we're going to peel back the onion a bit and see what was really going on behind the results. After that, we'll dive into their guidance and the headwinds they're facing. We'll decode that wild market reaction. And finally, we'll talk about the next call and what we should be looking for. Right, so let's start with the good stuff. That first wave of news that hit before the bell, it was all positive. I mean, P&G came out swinging with a really solid quarter that beat what the analysts were expecting pretty much everywhere you looked.
So first up, let's talk about the bottom line. Core earnings per share. It came in at $1.99. That's a full 9 cents higher than what Wall Street had penciled in. That's pretty significant. It tells you they're running a tight ship, really controlling their costs.
And it wasn't just the bottom line. The top line looked just as strong. Revenue grew 3%, hitting $22.4 billion. Again, better than the forecasts. So think about it. More revenue coming in the door and better profits than anyone expected. I mean, that's a textbook beat, plain and simple.
Yeah, this chart really lays it out perfectly. Wall Street was looking for 190. P&G comes in and delivers 199. Boom! Seems simple, right? So based on this alone, the stock should have had a fantastic day. But it didn't. And that, my friends, is where this whole story gets really interesting. See, once everyone had a minute to actually breathe, digest the full report, and listen in on the earnings call, a much more complicated picture started to emerge. And suddenly, the quality of that beat, well, it started to come into question.
And this is the first major red flag. Let's break down that 2% organic sales growth. Okay, so 1% of that came from just hiking up prices. Another percent came from what they call mix, which is just a fancy way of saying people bought their more expensive premium products. But then you look at volume. The actual amount of stuff they sold? Zero. Flat. They didn't sell one more unit. All that growth was from charging more, not selling more. That's a big deal.
And that whole flat volume story, it gets even dicier when you look at the different parts of their business. So growth was awesome in their premium stuff, like skin and personal care. We're talking high single digits there. But their bread and butter, the core high-volume segments like fabric and family care, that was actually down. What does that tell you? It tells you that we, the consumers, are being super selective. We're splurging on some things, but definitely cutting back on others.
So, you might be asking, what's management's big plan to fix this? Well, their answer, and believe me, they said this about 1 million times on the earnings call, is a strategy they call integrated superiority. It sounds fancy, but what it really means is they believe their products are just so good, so premium, so innovative that people will happily pay more for them even when money's tight.
Okay, but here comes the reality check. That whole superiority strategy, it's hitting a wall. Their global market share actually fell. Less than half of their key product lines are even holding on to their share, let alone growing it. And then the CFO comes right out and admits there's heightened competitive activity. You know what that's code for, right? It's corporate speak for our rivals are eating our lunch with discounts and promotions. And all of this leads us to the next critical piece of the puzzle for investors. What about the future? What did management say about the rest of the year? Honestly, this is the part where all that initial optimism from the headline beat just poof, vanished into thin air.
Okay, now this is a huge one. Listen to this. Despite crushing expectations in the first quarter, P&G did not raise their forecast for the rest of the year. That is a massive signal to Wall Street. It basically says, yeah, Q1 was nice, but don't get used to it. They're telling us they don't expect this to continue, and they're sticking to a really conservative outlook.
And when you look at why they're being so cautious, you see some major hurdles baked into their forecast. They're bracing for a roughly $400 million hit after tax from tariffs, plus another $100 million from commodity costs. Now, they get a little help from foreign exchange rates, about $300 million, but do the math. The net impact is still negative, and that puts some serious pressure on their ability to grow profits.
And then, just in case anybody on the call missed how cautious they were being, management dropped this little bombshell. They came right out and explicitly warned everyone that the second quarter will likely be the softest growth quarter for the year. Now, if there's one thing investors absolutely hate, it's a negative surprise. And this was basically P&G pre-announcing a weak quarter right to their face.
So, let's put it all together. We've got a headline beat, right? But underneath, we've got this weakness in volume and market share, and it's all wrapped up in a super cautious, challenging outlook. So, how did this all play out in the stock price? Let's take a look.
And this timeline, it tells the story of the day just perfectly. Look at this. Step 1. Before the market even opens, the stock pops over 3.5%. Why? Because of those great headline numbers. It holds on at the open, but then, as that earnings call goes on and all the analysts start digging into the exact details we've just been talking about, the stock starts to fade. And it just keeps fading, giving up every single bit of those gains to close almost completely flat.
And listen, this wasn't just some quiet little drift downward. We're talking nearly 12 million shares traded hands. That's way higher than its normal daily average. What that tells you is that there was a real high-stakes debate happening among investors all day long. And by the time that closing bell rang, it was clear. The sellers won. The negative details completely outweighed the positive headlines.
All right, so where does that leave us? Where do we go from here? Let's put on our analyst hats for a second and look ahead to P&G's next report.
Look, given that management basically gift-wrapped us a warning about a soft Q2, we're forecasting a pretty significant slowdown. We expect that organic growth to slow way down, and frankly, we think product volumes could actually dip into negative territory. And if that happens, it's going to put a real cap on any kind of earnings growth.
So with all that in mind, our rating on the stock is market perform. Look, let's be clear. P&G is an absolute beast of a company. They execute incredibly well, especially in a tough environment. But the reality is you've got this weak volume growth and these huge economic headwinds that are probably going to cancel out all that great execution. So what does that mean? We expect the stock to perform pretty much in line with the rest of the market.
So the big question is, what's the trade? How do you actually use this information?
Okay, here's an idea. A defensive pairs trade. You go long Procter Gamble, but at the same time you short a basket of consumer discretionary stocks. Now, what's the logic here? Well, everything we heard in P&G's earnings call points to one thing: a cautious, value-seeking consumer. That person might put off buying a new car, they might skip the luxury handbag, but they are not going to stop buying Tide and Pampers. So this trade is a bet on the stability of staples like P&G versus the vulnerability of companies that rely on people spending money they don't have to. This is not financial advice,